All right, ladies and gentlemen, we did finish the week fairly strong here. We actually had a breakout, and Monday is going to tell us if this is a false breakout and a bull trap, or if things are now going to be in a positive sentiment going into some seasonality here and with a tremendous amount of money still on the sidelines. What did we see happen here? Well, yields pulled back. Markets now broke out of 4,400, which was a key level. Guys, you can see the correlation here of TLT versus the stock market. As TLT is coming down, meaning yields are going up, stock market is absolutely responding to this. We can put higher multiples on stocks for multiple reasons when yields are coming down. Less money for assets to go, first and foremost. Secondly, cost of capital comes down. So yes, yields are extremely important. And so today we're going to talk about what makes you guys buy stocks. Why do you buy an individual stock? And when do you know when to sell it? And so we're going to talk about fundamental analysis here. And when we think about fundamental analysis, what I'm showing you is a chart here that's called a technical analysis. So on the technical analysis here, we can see that the black line, which is the S&P 500, is definitely breaking out of a downtrend. And this could be very, very bullish if we get multiple closes above this trend line. We start seeing buying pressure come in here. The technicals are telling us that markets could be going higher. And so what we do and what we focus on this channel is mainly fundamental analysis. We take our emotions out of the equation. We take the hype out of the equation. We take the stories out of the equation. We think about forward guidance. We think about the balance sheet, companies' revenues, companies' earnings, what's their future revenue, what's their future earnings going to be, what kind of mergers and acquisitions are they making, how good are they at deploying capital, meaning how well do they do when they get returns on investments. And so that is all fundamental analysis. And where the fundamentals and technicals line up is usually around earnings. Price action will follow earnings, which means that the technicals will eventually follow the fundamentals, or the fundamentals will eventually follow the technicals, one or the other. Now, if you're new to the channel, I like to personally kind of stay away from your bigger mega tech companies because their prices are probably perfect priced, meaning I'm probably not going to have an opportunity to beat the market with your more mega tech companies unless if they go tremendously on sale and I get a ridiculous buying opportunity. But overall, I like to stay in the mid cap area to small cap area. I do deal with some large cap companies, but they have to be companies that are tremendously undervalued or have a value proposition that I think the market's overlooking. Either way, regardless, it doesn't matter if I'm looking at small caps, it doesn't matter if I'm looking at mid caps, and it doesn't matter if I'm looking at the mega tech large caps. What matters is, are my valuations reasonable to make a risk versus reward purchase on an individual equity in order to get an above average rate of return? If I'm looking out here and I'm not seeing any stocks that look to be on sale, and for 99.9% of people, guys, you should be dollar cost averaging into some sort of equal weighted index and some sort of equal weighted global index. If you're a person that's buying individual equities, you better have a process, whether that's using technicals or fundamentals, or it's using a combination of both. Now, me personally, and what we do on this channel is we do try to use a combination of both. So in this video, we're actually going to stay focused on fundamentals and where I tend to find the biggest opportunities. And today, I actually want to break down one stock. Now, regardless if you own this stock or not, doesn't make a difference. I just want to take you through this process and show you how important it is not to just plug random numbers in, not to just make stuff up, but to actually go into the nitty-gritty of their earnings, what their projections are, what their margins are, and what they're capable of actually getting on returns on investments. So with most companies' earnings being over, there are a few out here that we've been looking at. Cisco and Target are two I'm going to actually highlight here. I think for this example, we'll probably use Target here. Cisco is actually a company I'm very interested in. I actually really like the Splunk deal. Cisco seems to deploy capital fairly well. Valuation seems appropriate on the company. I don't think it's a cheap company, but I also don't think it's extremely expensive. So that is a company I am personally interested in. But let's take a look at what our price target is for Target. So I have two price targets here for Target. Now, the first price target is what we call the DCF calculation. This is going to be the discounted cash flow calculation. And so this is basing off of future cash flows, discounting them to present day value to get a stock price right around $100 a share. And then we have a multiple of EBITDA. Now, this is what I personally like to use a little bit more. but averaging these two out is best to get an ideal price target. So with a multiple of EBITDA here, what I'm basically doing is I'm taking what the company has shown us they're capable of doing with growth rates, with margins, with stock dilution. I take all these things into equation, and then I put a rate of return that I'm personally looking for, which is eventually going to discount the stock. So I personally get a compounded rate of return of, let's just say 12%, as this example showing us, to give me a price target that I should be buying the stock. And so when we look at the price target here, I get a $92 to $93 price target. I give myself about 5% to the upside and 5% to the downside. So anywhere from $89 to about $95 a share is probably where I should be looking at building a position in a company like Target. So this model is nothing fancy. It's just annualizing out exactly what I'm projecting out the company to do from a revenue standpoint, from a margin standpoint, from a dilution standpoint, what I think their debt's going to be in the future. I put a multiple of EBITDA on that to get a valuation, minusing out cash and debt, divide that by the outstanding amount of shares to get me an individual stock price. And so that's personally what I do. It's nothing crazy, it's nothing fancy, but it's just something to give me an idea of what I think a stock should be going for. And so if I wanted to be interested in a company like Target, should be looking anywhere from $89 to roughly $100 a share, as we can see by the examples that are set forth. Now, I did this analysis about a year and a half ago, and the stock was much more expensive, as we can see by the chart. The stock was pushing, $150 a share, and I started to get right around $100 to $95 price target. And we can see here that tells me that I should be waiting here. And it's not always going to be right, because sometimes the markets are irrational. Sometimes there's things I'm missing, or sometimes the company actually executes much, much better than anybody anticipated. And so you do get that stock pop, and you might never get that price target that you were looking for. But every earnings call I listen to, and I adjust my analysis based on what they're currently doing. Are margins shrinking? Are they expanding? Are they doing well on deploying capital? All these things add up to an individual stock price. And we can see here that the 52-week low in the stock was $102. So this earnings is actually going to be a very, very important earnings, because we can see that right around that $100 mark is where buyers are coming in. But if they disappoint on earnings and we break $100 a share, the stock could go much lower, and maybe that $89 a share is not really out of the picture here. Another thing that's extremely important about buying an individual stock is understanding the sentiment around the stock. Are people bullish? Are they bearish? We see that Target is trading for right around $108 a share, but analysts have as high as a $195 price target and as low as $116. So maybe there is opportunity here, but we're going to stick to our analysis. We're just using this as a reference point. And so at this point in time, I'm analyzing this stock. I'm not seeing any reason to buy it, not seeing any reason to build a position, because number one, it's close to my price target, but I know they're reporting earnings and I know they're dealing with a lot of problems. So what do I want to see? I wanted to see them fix these problems. I want to see how the market reacts to this. And then I want to replug in my numbers. But we're trying to figure out if there's an opportunity here, because we are pretty close to our buy target. And just taking a look at how the company deploys capital, return on invested capital, getting over a double-digit rate of return, very, very solid to see. The other thing you're going to notice with a lot of these retail companies is margins are going to be very, very slim here. Gross margins are at 26%, but operating margins are at 4%, which means that there's not a lot of wiggle room here with prices. If they're not a leader or have a competitive advantage in their industry, and it's a low margin industry, much like retail here that we're seeing, very high risk investment. But something like Target, is well known. They have great brands. And so they can probably sustain a lower margin because of the amount of volume that they're doing compared to smaller companies. The other thing you're going to notice is with lower margin businesses, they're not going to get a high multiple. And just as I stated, we can see here that the PE ratio is sitting right around 15 times, while the forward PE is sitting right around 14 times. So when we think about this is not really an outrageous multiple. But then when we think about a company like Walmart, is most likely Walmart's going to trade for a premium. And so we can see here that Walmart is trading at a 32 PE ratio, while the forward PE ratio is sitting at 25 times. So a much bigger multiple when we compare it to a Target. So Walmart is in the black and Target is in the red. And this is a 5-year chart. And take a look at the performance over the last 5 years. In easy monetary policy, the consumer is spending, we have low interest rates. Take a look at the performance of Target here. And so as an investor, we're seeing the performance be a difference, and we're understanding that where we are in the economic cycle is definitely going to matter onto what businesses we want to be overweight versus what businesses we want to be underweight. We want to be overweight a Walmart when we're in a tightening process and possibly heading into a recession. We would rather be overweight Target in an easy monetary policy, low interest rate environment, and while the consumer is red hot. And so hopefully this was helpful on when to buy and sell a stock. And so what would be an ideal price to possibly sell a Target at? Obviously, we have to update our financial statements as the company's reporting earnings, because that's going to change everything. But if I were to buy a company like Target around $89 to $95 a share, I'd be looking to sell right around $260 a share before 2031. And so if the stock, all of a sudden, if I bought the stock and the stock shot up to $200 a share by 2027, I may be taking profits at that point because it's pulled forward so much stock price and so much percentage gains that I could probably deploy that capital somewhere else to actually perform better longer term. So as always, guys, really appreciate everybody's time. Hopefully everybody enjoyed a dive into a fundamental analysis on buying individual stocks. We will see you in the next one.